I had planned to cover the second part of my defensive strategy series, but with the market taking another dive as investors take in Powell's latest moves and World Bank start to hike rates, it seems more pressing to address this. So I'm going to do a short video on this, explaining my view and how I'm handling the volatility. With the Dow tumbling 500 points into a bear market and the S&P falling 1.72%, setting a new low for the year, it's a new wave of pessimism and gives credit to the multitudes of analysts and fund managers with the repeated warnings of further drops and a high possibility of a recession. In the UK, we have a new Prime Minister who announced new tax cuts as part of her strategy to beat inflation, dropping our 20% tax rate down to 19%, but also following up on her promises to help the wealthy by cutting the higher tax rate for high income earners, showing we have yet another potential story bringing more austerity to the UK. This tax drop is likely to create further government debt, so the Bank of England are already raising rates by 50 basis points, UK bonds are hitting new highs, and the FTSE has fallen back to March levels. Thanks! This is a global issue as compared to the dollar, the pound has fallen sharply 3.67%, the euro 1.5%, as well as other currencies react in similar ways, pointing to recessions for everyone. So another 75-point rate hike is enough to trigger another sell-off into a bear market, as if Powell wasn't clear from Ms. Jackson Hole's speech that the Fed would do whatever it takes to avoid a recession. And back in June, he said the Fed might even go too far.
Is there a risk that we would go too far? Certainly there's a risk.
With rate hikes becoming a monthly experience, Powell has driven so much fear into the market that it seems an entire generation of investors are being blown away. The S&P has fallen 23% year to date, 10.81% over the last month, 4.3% over the last week, before the 1.72% on Friday. So it's clear the market has been in a downturn for some time, and it's no surprise to see the market drop further, especially when the last round of earnings showed how many companies cannot justify their stock prices. Anyone not seeing a need for correction clearly wasn't listening.
We didn't listen! We didn't listen! We didn't listen!
If you think the Fed has gone too far, or that it's unfair to continue to raise rates, consider how many stocks are trading at ridiculous fundamentals, with the average price to earnings ratio in the S&P at 18.66, whilst house prices are reaching all-time highs. The cost of living, food, fuel, energy, all going up as the US deals with labour shortages and wages that fail to keep up with inflation that still hasn't come down from its current 4.8% to the planned 2%. Just compare the Fed rates to previous decades to see how low they have fallen, and the impact of COVID brought them down to ridiculous levels in a market that was clearly overheating. The system was clearly not working, and Powell is prepared to blow it all up to avoid a recession. Maybe he's going to go too far, but as Powell puts it, you can have the pain now, or you can have it later. But one way or another, it's coming. This strategy is either going to fail and bring about a recession, or it's going to avoid it, and if successful, you can expect Powell to pivot, and when that happens, be prepared for the mother of all bull rallies. Investors who exit the market could miss out on the bounce, and a history of stock market has shown that although missing the worst days in the market is ideal, missing the best 10 days per decade can have a substantial effect on your overall gains. So until then, investors need to be cautious about how much money they're putting into the market and what they are holding, and missed earnings are going to be disastrous, so you cannot afford to be holding unprofitable, hyped up companies trading at high fundamentals, or pretty much anything in Cathie Wood's ARK fund. What irritates me is this constant talk of a bottom. The suggestion of a line in the sand where the market is going to pivot and every stock is going to decline. It's a generalization that takes investors for fools who need to be told when they can flood into the market like lemons and buy whatever's been promoted, and until then you just have to take the pain. I don't accept that. You can't look at the market downturn and assume this is justified for every company out there, as if there aren't good oversold companies that make great investments for those able to see past the short-term fear in the market. I recently started outlining my defensive strategy for a possible recession, and this essentially involves identifying strong, long-standing companies with consistent earnings, growing cash positions in sustainable industries that will hold resilience in a recession. Yes, that's a mouthful, and that's why I'm going to be breaking these companies down over my next series of videos, because I don't want people buying stocks just because I throw a name out. I want to help you understand which fundamentals in a business are needed right now. If you want a practical approach, you can use leverage to counteract volatility in the market, and what is often a very challenging and technical method of trading is much easier when the market sentiment is at an extreme in one way or another, like it is right now. My portfolio is currently 7.84% down on my current holdings, which might seem high or low compared to you, but what I have been doing is focusing on leveraging the markets, shorting overbought stocks like Nvidia, leveraging the volatility in gas and oil prices to generate cash.
I don't get it. You see, phase 1, collect underpants. Phase 2, phase 3, profit. Oh, I get it. No, you don't, fat ass.
Which I'm using to grow a 10% cash position for future use, with anything over that amount going towards dollar cost averaging on oversold stocks or towards my defensive strategy, which I've started to explain on my channel. Just remember that when it comes to volatility and leverage, winners know when to take the cash and run before sentiment changes, and leverage positions can flip very quickly. If your portfolio has been hit, here's some things to remember. Even if your stocks have come down, you still own the same portion of a company and you haven't lost anything until you sell. If you're holding stock in a profitable, cash-generating, growing business at a fair price, how likely are they to disappear in a recession? Where will they be in 2 years' time? I'd rather be pulled kicking and screaming into holding a long-term position in a profitable company than sell out at a loss. That's all I can say for now, and I hope this does relieve some panic out there. And as always, if you have any thoughts or comments or questions, please comment below, let me know. And if you like what you see and you want to see more, remember to smash that like button and subscribe so you don't miss out. Until next time.